Welcome to another episode of Brett's Brain. Today, we're going to answer a question from one of our viewers. What should you expect from an investor once they've invested in your company? I'm Brett Brohl, former entrepreneur, current venture capitalist. Thanks so much for checking out the channel. Make sure you share, like, subscribe, and help out other entrepreneurs that are trying to make it happen in their journeys. Okay, so what should you expect from an investor once they've invested in your company? Now, this is nuanced and it depends is the real answer. And really what it depends on are what type of investor is this person? So if we start at the earliest stage, like angel investors, that's going to vary widely and there should be no universal expectations for angels. Some angels really want to be helpful. They really want to dig in. They'll let you use their name. They'll make biz dev introductions for you. They'll help with strategy. They'll help with advice. Some angels will give you their money and not be involved at all and hope that you give them more money back at the end of the day. And really everything in between. Hopefully you avoid those angels that are going to work against your company or take a whole lot of your time, but don't really add much value. So that's what you really want to watch out for when you bring on an angel investor. Now, when it comes to institutional investors, and an institutional investor is just a venture capital fund, but it's somebody that is managing other people's money, like us at Bread and Butter Ventures. For an institutional investor, it can also vary, but you can have a bit more expectations there. And it's something that as a founder, you should be looking for and asking about while you're going through the diligence process. Just like we are doing diligence on you and trying to figure out, should we invest in you? Do we want to partner with you? You should be doing diligence on those investors. And you should ask questions like, hey, how do you support us post-investment? Do you reserve capital for follow-on rounds of venture? So you should be asking those types of questions, and you should be doing reference calls with at least one of their founders that they've invested in previously. If an investor is going to take a board seat on your company, make sure you talk to a founder whose board that they're on as a reference. And so do your work up front, and that will give you an expectation or some guidelines around what to expect from them once they are on your cap table and they are already an investor. Now, a lead investor, whoever leads you on, should be pretty involved. And I'll just give you an example of what we do at Bread and Butter. So when we lead around, we try to do at minimum monthly meetings with that founder. We're always available on call. We use WhatsApp, text, for quick voice memos back and forth to help and answer questions. If you need extra time outside of our monthly meeting, we can set up additional time to walk through things. During fundraising processes, we get really involved to the extent of weekly meetings to talk and help with strategy and introductions. But different funds will do different things. If we're on the board, we obviously have a fiduciary responsibility, and we take that incredibly seriously, where we work really hard and really closely with the founders on everything from financing, finance strategy, employment strategy, salaries, all of those things. So we're really involved when we're on the board of a company. And that's at probably the most detailed and intimate level with the founder. And so it does vary even for us, depending on whether we're a lead investor or a follow investor. At the very least, though, we try to not get in the way and try to be helpful with biz dev introductions for talent, and really leaning in and helping with introductions and strategy around your future fundraising rounds. And, we do write sizable checks for seed stage companies. And so we do want to back that up with a lot of our time and be really involved with our startups. There are institutional investors that write smaller checks. In our first fund, we wrote really small checks, and we didn't have the knowledge really to be as helpful as we do today. We were still getting the lay of the land and understanding, what our place was and where we could help and where we should shut up and where we should get super involved. And so that was when we were writing smaller checks. We would own less than 1% in some cases in many companies. And so it didn't make sense for us to get really involved. So there are institutions that hopefully every one of your institutional investors, if you email them and ask them for help directly, they will at least respond and say, yep, happy to do it. Or B, I don't have that connection. I'm not able to make it. At best, people are doing, leaning in, making introductions and being super helpful. At worst, there are those investors that do tend to feel like they're working against you, even if they don't realize it. And so managing those expectations up front is super important, as is doing your research on the funds before they invest to understand. So if you have expectations and they set expectations for you, you should hold them to whatever they promised prior to investing. And at the end of the day, that's actually what you should expect from a relationship between you and your investors, is what was agreed upon prior to that investment happening. Now, understand that also changes over time. Once we invest, we're really, really active and try to help you get to your Series A. Once you raise a Series A from a really great lead investor, we might not be as important as we were prior to, because now you have other great investors around the table that are helping you, and our expertise is in that super early stage. Now, we do tend to stay in touch and continue to help all the way through growth equity rounds with our portfolio companies, but we do become less involved. Even in many cases, we'll actually roll off boards and let new investors take our board seats that are better at that growth equity stage than we are. We're really good at helping you go from 0 to 10 million. And there's probably people that are more experienced than us going from 10 million to exit. So that's also helpful, is to have investors that understand where their expertise is and where they can help the most. So you can replace them with people that are better than them at that time. So that's our quick answer and quick overview on what to expect from investors. Hopefully this was helpful. Make sure you continue to ask questions, like, subscribe, share, do all those things, and we'll see you on the next Brett's Brain.